Bhav Bhagwan Che is a Gujarati phrase that means price is God. And while it sounds like a slogan, Bhav Bhagwan Che is more of a philosophy that implies that the stock market is always right. Now, different stakeholders have a different take on the importance of price, which is something we'll be spending a little time on in this video. Let's start with traders, the people who buy and sell stocks on a short-term basis. For these guys, the price is without doubt their God. In fact, if you ask a trader, he or she is most likely to say that while the price is the god, the trading volumes happen to be the goddess in his investment temple. And that's true because for traders, these are the only two things that matter to them. And using a combination of price and volumes, they aim to predict where the direction of the price will be and take a long or short position accordingly. Of course, they have all sorts of systems that they use, which includes things like charts, swing trading, stochastic models, moving averages, patterns, etc. Now, I don't understand most of it. Actually, I don't understand any of it, but that's by choice rather than my own belief. In fact, with age and experience, I think I've become a lot more open and curious, and you might have seen evidence of that in some of our other videos on the ET Money channel, where we have looked beyond classical investing and have explored a number of alternative paths. Anyways, for traders, Bhav definitely Bhagwan Che or volumes bhi Bhagwan Che. Now, another set of players who rely a lot on price are momentum investors. Unlike traders who buy and sell within a day, momentum investors stay invested in a stock for a 3, 4, even a 6-month period until the direction of the price reverses. So if the price indicators are going up, they go long, and if the price direction is going down, then they go short. In fact, their favorite one-liner is, "The trend is my friend." But having said this, these momentum guys are mostly fundamental investors, but they do have an eye on the markets and they're continually tracking the trading volumes, the stock prices, news, and other moving trends. This equips them to take important decisions on the entry and exit timing of their investments. But as I said before, for momentum investors, fundamentals matter, but so does the price. Finance professors are another advocate of Bhav Bhagwan Che. Well, to make it more formal, they believe in this theory called the efficient market theory, which simply says that a security's price reflects all relevant and known information about that asset. In other words, what the EMT is implying is that all this stuff we do, the fundamental analysis, the technical analysis, discounted cash flow, relative valuation, etc., is absolutely useless and one should simply buy the market or the index. In essence, the people who believe in the EMT, for them price equals value, which means for our finance professors, Bhav Bhagwan Che. Now, there's an old joke that an accountant is someone who knows the cost of everything and the value of nothing. Case in point is how mark-to-market accounting is used to record a company's investment in other listed companies. Now, since the price of those shares keeps going up and down on a real-time basis, in essence, the worth of the companies holding in these shares also moves up and down with changes in prices. The same principle is seen with mutual funds and the insurance industry, which also invests funds in publicly listed companies. This then leads to the NAV or the net asset value, which is exclusively derived from the current market price of their portfolio holdings. And that really makes sense. I mean, yes, all fund managers believe that the stocks they are invested into are grossly undervalued, which means the price at which they buy is at a discount to the value of that stock. But that, of course, does not mean that anyone is going to allow the fund manager to declare an NAV on the basis of his or her perceived value. And so, yes, in accounting terms as well, Bhav Bhagwan Che. And finally, let's talk about the regulators who, believe it or not, also worship price for all practical purposes. You see, what does a regulator really want? They're not interested in valuation or any such mumbo jumbo. And what they are really looking for is that the prices have to be determined in a fair and transparent manner with proper disclosures and without any manipulation. And since they are only keen on the price, therefore for our regulators as well, Bhav Bhagwan Che. Now, we always give credit where it is due, and a lot of what we have in this video comes from one of Professor Sanjay Bakshi's video logs. So if you haven't watched it yet, Professor Bakshi has a wonderful channel on Vimeo where he posts some high quality content from time to time. It's something I follow on a regular basis, and there is a lot to learn from what he has to say, so do consider watching and subscribing to his channel. Hi, we've just launched ET Money Genius, and I'm sure everyone has a lot of questions on it. So next week, join me as I put together everything one needs to know about Genius in a video. What it is, how does Genius help you, the different portfolios across mutual funds and stocks, how have they performed, the charges, etc. You'll learn quite a bit in the process, and hopefully you'll want to be a Genius member by the time we are done. So do subscribe to our channel and tap the bell icon for an alert on when we release that video. See you there. A majority of people, that's like 99% of them, use stock prices as a proxy to value. And one can understand why they do that. After all, price is an objective measure, it is precise, it is always visible, it can be measured, and most importantly, the price of anything is very easy to verify. Working with price makes it convenient for everyone, the investor, the regulator, the company, accountants, the media, and many of those finance influencers who seem to be growing by the day on YouTube, Instagram, and Twitter. So instead of having to figure out something so complex as an intrinsic value, most of these stakeholders prefer to substitute value with price, which then label it as the stock market's collective wisdom. But the real question is price an accurate reflection of value? In that context, let's understand things from the perspective of a value investor. Now, the word value is a super fuzzy concept and can mean different things to different people. It's like that story you would have probably read on LinkedIn somewhere, where a man sees 3 people laying bricks and asks each of them, "What are you doing?" The first one says, "I am laying bricks." The second one replies, "I'm building a wall." And when this man asks the same question to the third one, this bricklayer replies, "I am constructing a castle." So while all the 3 were doing the same task, each of them valued their contribution in a different manner. Value investors are a bit like that, and they seek to paint their own picture irrespective of what the rest of the market is saying. They do this by insulating themselves from emotions, by trying out multiple valuation models, and they have that brazen conviction and patience with their stock picks. In other words, Bhav Bhagwan Che is not true if you look at it from their perspective. But to say that Benjamin Graham, who is often called the father of value investing, to be somewhat of a purist would not be entirely accurate. In fact, Graham himself kept a price-based criteria with the specific purpose of not falling into value traps. You see, while Graham advocated the buying of cheap, or might I say, below intrinsic value companies, he had no way of knowing which ones will go up and which ones will not. So he realized that some of his investments will be super duds that produce no returns or might even fetch negative returns. And so he came up with a 3-year rule, which simply meant that if a stock in which he had invested does not go up to the expected price level over a period of 3 years, then he would simply exit that stock at the end of those 3 years. Another variation of that is what Professor Bakshi highlighted in his video, and I thought it needs a mention here as it explains the linkage between the stock prices and a company's credit rating. Now, this might sound a bit unusual to you. After all, what would the stock price have to do with the credit rating of a company? But when I look at it with some actual examples of downgrades in the last 6 months, this point starts to make more sense. You see, these graphs here highlight the level of price declines that these stocks have had before the actual date of the downgrade. For example, CRISIL downgraded the ratings on BHEL's long-term bank facilities on the 19th of August of last year. The report justified the downgrade, pointing to the company's weakening business and the corresponding financial risk. But what's interesting is that the stock market reacted before the credit rating agency's report and started shorting the stock from as early as June of 2021. In essence, an unanticipated stock price decline can act as a signal for the credit rating agency to reinvestigate the company's finances and see if their assumptions are still holding. It's a wise thing to do in this case, and hence for the credit rating agency as well, the Bhav is somewhere there in the picture. The entire basis of equity research is to estimate the projected share price of the company based on the information available. and on the face of it, the current price of the stock should not really matter. But often equity analysts make the mistake of contaminating their research by basing a lot of it using stock prices. Let's look at a couple of examples here. The first scenario is where a company has one or more listed subsidiaries. This would typically be companies like HDFC, Tata Investment Corporation, State Bank of India, etc., which have a number of subsidiaries, some listed, some unlisted. Now, what analysts often do, especially with the listed subsidiaries, is that they pick the listed subsidiary's market capitalization and multiply it with the company's stake in that subsidiary. For instance, the State Bank of India has a 55% stake in SBI Life Insurance, it has a 69% stake in SBI Cards and Payment Services Limited, and a further 30% shareholding in Yes Bank. Now, as we see in this table, analysts would multiply these stakes with the respective subsidiaries' market capitalization, which will then help them arrive at the cumulative value of the subsidiaries in the holding company. This might look very logical at first, but the problem with this approach is that the analyst's research is missing the independent valuation of these three subsidiaries. You see, by not properly valuing the subsidiaries and by simply using the price-based market cap numbers, the analyst is exposing his research to the vagaries of the subsidiaries themselves being overpriced or underpriced as compared to their value. So that's something that one needs to watch out for. A second scenario which can lead to mistakes and which frankly a majority of people do is peer valuation. A peer valuation is the simple act of looking at how similar competitors within the same industry are doing on some specific metrics like the P/E ratio, the return on equity, etc. Take for example large IT companies in India. So we have 7 companies here, and if we use the P/E ratio as our preferred metric, then we can expect a lot more interest in Wipro and HCL Technologies as compared to TCS and Infosys, which are on a higher P/E ratio. Now, there is no reason to suggest that one should not do peer analysis. In fact, understanding competition is incredibly useful and gives us a fantastic idea of the business drivers, margins, order books, R&D pipeline, and the entire landscape. But if an investor is basing his or her investing decision entirely on a relative P/E ratio, which is part price, part earnings, it may not be the smartest thing to do. After all, there is a reason why a Wipro or HCL Tech has a low P/E ratio, and unless one digs deeper into figuring out the why, it will leave room for critical investment mistakes on your part. So we have seen two ideologies when it comes to price. Firstly, there are value investors who believe that price and value are different, and it's that belief that allows them to find discrepancies and make money from valuation gaps. The second stance that most of the other stakeholders have is that one should always trust the price and all determinations should be based around it. We observed this in the case of traders, accountants, momentum investors, financial professors, and regulators who continue to chant the Bhav Bhagwan Che mantra. Now, in our opinion, there are times when value and price should be treated as independent variables, and there are other times when it should be treated together. In other words, your approach should match your objectives. But having said this, the market price also serves as a powerful signal to the management, and it is in their interest to pay heed to it. Take, for instance, corporate announcements. Now, when any new information is shared by the company, there is almost always a market reaction. We think the understanding of this reaction is an important step. For example, Aurobindo Pharma announced on the 12th of August last year that they were acquiring a 51% stake in Cronus Pharma Specialities India Limited. This deal was being done for a cash consideration of 420 crores. But what surprised and spooked the market was that this company, Cronus Pharma, had a sales turnover of just 12 crores for the previous financial year. What followed was a major sell-off, with Aurobindo Pharma's share price tumbling by 18% over the next 5 trading sessions. What spooked investors were the concerns with this deal on account of a high valuation, possible related party transaction which the company later denied, and of course an increased capital outlay for the year. So the market did not take this news well, and this episode has been like an albatross around Aurobindo Pharma's neck ever since, in spite of the company terminating the deal within a week or two. The point is, you may agree or you may not agree to Bhav being Bhagwan, but there are a number of areas that are influenced by the stock price, and as an investor, it is in our interest to understand that. And with this, we come to the end of this video. If you learned something new today, then do share this video with others. Do like this video and don't forget to subscribe to the ET Money channel. Thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.